Welcome back, everyone. Let's get started with our next panel, all about the Benjamins, Treasury Management for DAOs. Our moderator for this session is Professor Laurie Hodrick, the A. Barton Hepburn Professor Emerita of Economics in the Faculty of Business at Columbia Business School. Laurie is a fellow at the Rock Center for Corporate Governance, a visiting fellow at Stanford, and she has taught advanced corporate finance at Stanford Law School for the past 5 years. Laurie serves as an independent director and chair of the audit committees for Roku, Andela, and as an independent director and member of the audit committee of Prudential's PGIM funds. Formerly, Laurie was a managing director and global head of alternative investment strategies at Deutsche Bank and has served on numerous other private and public company boards. Lovely to see you, Laurie. I will turn it over to you.
Thank you, Kristen. I'd like to welcome everyone today to this session on Treasury management for the DAO. A Treasury has stewardship over the company's financial assets and liabilities. So active Treasury management includes cash and liquidity management, asset management, and capital structure management, while mitigating credit and operational risk and financial risk. Specific Treasury duties and responsibilities include forecasting, reporting financial statements, and ensuring compliance with necessary and ever-changing regulatory requirements. One key Treasury management goal is the preservation of capital through the organization's time horizon, ensuring sufficient liquidity to cover upcoming obligations. The Treasury may seek diversification across assets and across counterparties in the presence of extreme volatility and uncertainty to ensure that its critical expenses continue to be funded, even if the native token experiences a significant downturn. The best Treasuries not only preserve capital, however, but are integrated into the strategic decisions that maximize an organization's mission, future success, and its token value. And DAOs must practice efficient Treasury management in a passive, permissionless fashion. Much of our focus today will be on understanding both how Treasury management principles continue to hold within a DAO and how optimal Treasury management execution needs to be adapted to specific challenges within a DAO, especially given how different various DAOs can be. We have an excellent panel to explore these questions, so let me start by asking each of them to please make a brief introduction. Flavia Romero.
Hi, everyone. Great to be here. I joined Coinbase as treasurer about 5 months ago now, and my background started in investment banking, so core finance, did some M&A both on the advisory side and also on the corporate side, and then joined Treasury and knew that was kind of where I was going to stay for a very long time. A little fun fact: my favorite game as a child was actually Bank, so it's very fortunate that I actually went down the track of treasurer. But very excited to be here with this panel and great to participate.
Thank you and welcome, Roberto Thomas.
Thank you. Thanks for having me here. My name is Roberto, and I am the head of data science here at Mizari. Mizari, as probably some of you know, is a data company that would try to aggregate crypto information and present in such a way that investors can make wise financial decisions in this new digital economy. I've been heading the data science team for about 6 months now. And previous to that, I was a research analyst at the firm, focusing entirely on DeFi and also DAO treasury management. Previous to Mizari, I worked at BlackRock as a risk manager, focusing on systematic trading strategies, and also spent quite a bit of time working on quantitative investing. So naturally, my transition into crypto was focused on DeFi and helping out DAO treasuries optimize the way they build their portfolios.
We're very glad to have you. And Shreyas Hariharan.
Hey, everyone. I'm Shreyas. I'm the co-founder of Llama. Llama is building economic infrastructure for DAOs. Specifically, we're working with some of the top protocols to help them think through their treasury problems and build solutions to allocate their treasuries effectively and assess results. And we've worked with Aave, Uniswap, Gitcoin, Pool Together, Fate Protocol, DYDX, FWB, and a bunch of other DAOs. And prior to this, I was at Duke University's endowment. I led a bunch of Duke's crypto efforts.
Go Duke. Sorry, can't resist that one. Our agenda today will first consider the goals of treasury management and highlight features specific to the DAO. We'll then consider specific treasury duties and responsibilities, and we'll wrap up with a speed round, offering practical tips for DAO treasury management. So let's begin the panel discussion with the objectives of treasury management. And the first question for the panel is, what are the goals of Treasury and how does the Treasury serve the DAO's mission? Flavia, as a corporate treasurer, I'd love to start with your perspective.
Sure. And maybe before I start, I will also just put a little disclaimer that I am somewhat new to the world of crypto, Web3, and DAO. And so my perspective is a little bit more traditional, but I think it's great, given the panelists that I have here as my peers. So I'll start with more of the traditional view. I think it boils down to two words. It's protecting and delivering. Protecting and delivering financial resources to be able to meet the objectives of the organization. So whatever those objectives are, whether it's nonprofit, it's profit, it's very mission focused, it's making a ton of money, those I think are really the key goals of Treasury. And in order to do that, I think about kind of three phases. So to add to that, in terms of beginning and setting a foundational base, that's key. So strengthening the foundation in order to make sure you have something that's very, very rock solid. Then it's turning over to scale, right? How can you then envision a world where you can grow and have tight controls from a security perspective, as well as the right pipes to ensure things are efficient? And then finally, it's to optimize, right? Everything that you build on top of that, then, it's kind of the icing on the cake, but the foundational piece is crucial and critical to the entire organization.
So Roberto, as you think about the DAO's treasury, could you discuss for us a bit the broad range of needs, from a simple shared wallet through Gnosis for your Austin DAO, which I enjoyed learning about, to the most complex treasury needs?
Yes, of course. I think as Flavia was saying, the goal of the DAO or the treasury of the DAO, it's going to change depending on the goal of the DAO itself. In many cases right now, we've seen an explosion in the kinds of DAOs that are out there. There's social DAOs, investment DAOs, protocol DAOs, and each one of them is going to have specific needs. In our case, for ATX DAO, we are entirely a social DAO. So our needs are very straightforward. We just need a treasury that is denominated in some stablecoin so that we can meet our US dollar liabilities. In the case of a protocol DAO, that can be a little bit more complex, because you treat your treasury as a balance sheet. And as most protocols, they have a core team that needs to be supported by this treasury. And also they need to find ways to not only support the core team, but also optimize and generate some of the yield that they need to grow the DAO, keeping in mind that they basically need this treasury as their war chest to keep the operations going. So I would say it's depending on the kind of DAO that we have out there. And the most prominent ones that we see are on the protocol side, and those tend to be the more complex ones that require quite a bit of more optimization from the treasury side.
Shriaz, as you think about the goals of Treasury and how it serves the DAO's mission, I'm interested to hear your priorities, including how important you think it is specifically to reward contributors and attract the right set of new ones.
Yeah, for sure. I generally agree with some of the points that the others have said. Growth and longevity are some of the critical things you're trying to optimize for with what you want to do with this pool of assets. I'd probably speak about what's uniquely enabled with DAOs and what's sort of different with these DAO treasuries. So DAOs are a very unique coordination mechanism, and these treasuries are denominated in native tokens typically, and DAOs are sort of these on-chain entities. And I think the really ambitious version of what you can do with these native tokens and treasuries is kind of build an internal economy, which is you're trying to use these native tokens to incentivize long-term contribution and participation in the case of protocol, to grow the protocol and to make it thrive and survive. So that might look different for different projects. So for example, for some DAOs, that means rewarding contributors by setting up these sub DAOs and actually paying them native tokens from the treasury. For some, it might involve building incentive systems where people can build on top of these protocols. So build on top of Uniswap v3, or build front ends for these protocols. Like there's a protocol called Liquidity, which is trying to incentivize they want to be quite unbiased, since they want to incentivize other projects to build front ends on top of their protocol. And so there's, I think, ways that you can think about distributing the native token that really grows the the long-term value of the project. And that can look different from whether it's manually paying individual contributors, whether it's setting up incentives to provide liquidity for your token, or to build these front ends for your protocol. It really differs sort of DAO, but I think the grand vision is like, you want this like thriving like internal economy that is powered by your native tokens and your treasury.
There's a lot to unpack here. We're starting to get questions from the audience as well. So let me open this question up to everybody. Flavia had mentioned, starting with a strong foundation, and then you've all mentioned ultimately growth and longevity and optimization. What are the pillars for that? What are the key thoughts and principles and practices for that? Who wants to take that?
Happy to start. Happy to start. So I think one, I'll just say I'm so excited to be learning more about DAOs, because I think there's just such a strong opportunity and such a powerful potential to improve the controls, for example, because at the end of the day, in the purest form, right, it's all source code that drives bylaws, if you kind of think about the core definition of the purest form of a DAO. And so that gets me excited, because when I think about Treasury and I think about the foundational piece, that's core. When I go back to your question around what are the pillars, right, in order to kind of meet those goals, the way that I think about it is the preservation of capital. If I start with that, then I'll move on to the delivery of capital. But on the preservation of capital, it's really just managing risks, right? And then when I think about risk, there's really two key buckets. One, you have what the folks in our world call systemic risk, which is really market driven. It's risk that you can't really control as a company, right? You can't really control the outside world and how people behave. So it's a lot less items that you can do, but you should still be prepared for it. So that's one key bucket. The other key bucket is what, again, most folks in the risk industry called idiosyncratic, which is then, specific to your organization. And therefore, those are things that you can control or mitigate, right? More so. Not to say that you can't mitigate, potential market risk as well, but it's just less out of your control. And so most of the folks end up focusing on the risks that they can control. And at the end of the day, when you look at history, most of the changes and volatility and, company behavior, as well as companies going down or going up, the majority of that is actually driven by the market, right? So it's actually a little small piece that you can control, but that's all you can do. And so when I then break down those types of risks, it's managing things like credit and counterparty risk, right? Who are your partners, and will they be there for you forever? Or are they going to default themselves? How strong are they from a reputation perspective, right? Are they going to, be good partners to you in the long run? Then there's things like operational risk, right? Are you strong in terms of all of your processes? Are there anything, any items, any pieces that could potentially break? You could have unfortunate, issues with rogue employees, right, that don't behave and can steal some money. You can also have some unintended fat finger mistakes, right, that were pure, silly mistakes that can cause also a lot of damage. And so in order to mitigate those types of things, you have things like insurance, right? From a credit risk perspective, you can have really strong processes to really have a very tight due diligence on who are the partners that you're bringing in, and how do you analyze and assess credit risk that you can mitigate. So for me, it's really just a matter of risk management. I think any good treasurer is a good risk manager. So that's the protect. On the delivery end, I like to always say, from a treasury perspective, you always have to have the right amount of money in the right currency at the right place in the right time. It sounds simple, but it can actually be extremely complex. And I like the simplicity of the blockchain, right? Some people may think it's complex. I actually think it's very, very simple. And I think that drives, again, a lot of efficiency. But there's two areas of delivery. It's internal delivery, right? And then for growth perspective, it's also how do you achieve more capital than what you currently have. So you're protecting your existing capital, and you're also protecting your overall profile in order to be able to go and seek out more capital, right? For folks to feel comfortable enough that you have a really strong organization so that they can give you capital and they can either lend it to you or they can invest. That's what then allows you to grow and do more, right? So you're internally generating capital if you're doing well. But if you want even more capital because you know that your projects are great and they're gonna, provide more mission for your organization, then you want to go and seek capital. And that's also something that, traditional treasury is in charge of. So going out to the capital markets, doing some debt raises, doing some equity raises, and anything in between.
So Flavia mentioned specifically issues of preservation of capital, which we will get to in a few moments. But before we do, let me ask the other two panelists whether they would like to add any additional pillars for strong foundation.
Yeah, I think probably just start with, what is the DAO, right? So a DAO is like an internet native organization that has its critical rules governed by smart contracts instead of legal contracts. And so you can encode things like membership, ownership, key assets, property of the DAO entirely on chain. And that's at the center, and at the edges, you have humans that govern really critical pieces of the DAO. And they can govern things like upgrades to the protocol. They can govern changes to the constitution of the DAO. And the third critical piece is they can govern the treasury, how the treasury is being spent and used. And so an analogy would be if, Stripe or Google opened up its balance sheet to the community to, decide how it's being used. And the few critical differences are that conventional corporate treasuries kind of, they have cash versus these crypto treasuries pretty much have native tokens. And native tokens, again, like a reasonably close analogy is like equity in these companies. But the equity is of an early stage private company that is also liquid. And so these analogies kind of, are like, they're always interesting parallels to draw, but they also like break apart because, what is it like for like a Series B type startup to have its token be liquid, and that token is its treasury, and it's sort of this like authorized but unissued stock in the company. But the token, it's still an asset in some ways because you can actually earn yield on it. You can exchange it with other DAOs. And so yeah, so some of the more foundational elements would be what can you the goal at such an early stage, even say Uniswap, which is one of the larger protocol treasuries, or Aave, which is one of the larger treasuries, they're still so early, right? So the core team is really focused on just building Uniswap E3 or the next version of the protocol, building additional like credit delegation features for Aave, and they're not they're not and everything else that should happen with the treasury and governance should help them achieve more adoption and help them last longer. And so I think few critical actions that are clear now that DAOs should do are one, diversification, and so this ties into the longevity piece, but making sure they have 2 to 4 years of operating expenses in stablecoins, because these treasuries can be extremely volatile and they can fluctuate 50-70%. And if you have $50-100 million in expenses denominated in dollars, it's weird having your assets in native tokens. And I think the other piece is liquidity provisioning, and so making sure you can kind of use your treasury to provide sustainable liquidity incentives to grow your protocol. And there's probably various ways that projects have tried to do this. It started with Aave and Compound two years back, but it's expanded to different other protocols building for this particular problem. But I think in general, like building on some of the more like foundational points that Flavia laid out, I would say specifically like diversification, liquidity provisioning, and maybe like alliances and sort of swaps with other DAOs with your native tokens are some of the actions that I think are clearer now that are really useful. And probably over the next few years, like as we unlock, as there's more improvement, innovation in DeFi, and DeFi especially that's tailored to DAOs, we'll probably see more interesting, innovative things you can do with your treasury that appreciate some of the nuances, which is that these tokens are these early stage liquid tokens. They are kind of equity in your project, but but yeah, like they should serve the goals of growing users for your protocol.
Roberto?
I think they cover pretty much everything, but I think the two core variables that are different from a normal treasury or like a quote unquote traditional treasury here is the fact that you have this native token and the fact that this treasury is also governed by the token holders. So you have a community that also can make decisions on the treasury allocation, and also you have basically this native token that is kind of like equity, kind of like unissued and authorized equity. So it's a little bit different from just like holding cash in like a normal portfolio. So having, from my point of view, having a very strong understanding of where your financial goals are and then building a treasury allocation to meet those goals is incredibly important. And also having a very good framework on how the community can be educated enough to make these decisions on how to allocate the treasury a lot better. Because in the more traditional world, you have a CFO that handles pretty much all the decisions. In our case, in the crypto case, you have an entire community, right? And that entire community can boil down to like maybe a couple of core team members that do the big decisions. But in the end, the community is the one that says, yes, let's spend $1 billion over here, $1 billion over there. So having a good way to educate the community and making sure that they can also in the end have the long-term goal, align the long-term goal of the community with the DAO, the treasury is really important.
So really interesting comments so far. So let's get a bit more specific into some of these things we've talked about, into preservation of capital, into diversification, and so forth. So let me start with preservation of capital, the idea of ensuring the critical operating expenses can be funded, even if the token has a significant downturn. So Flavia, you talked about some of these different priorities. So let me ask you to put a little more thoughts about how do you prioritize security, which is the recovery of the principal when it's due, versus liquidity, which is the quick conversion of cash, versus yield, which is an investment return. How do you think about, in terms of preservation of capital, those trade-offs?
Great question, Laurie. So I would say the first two for sure, way above in terms of priority. Like I said, there's always trade-offs, right? So in the traditional sense, you tend to always want to build the foundation because you don't want to then scale when things are broken. Because if there's major cracks and then you have all these losses of money falling through the cracks, that's not a good thing. And that could be a huge impact, right? So whether even probability is small, the impact of completely eradicating financial resources of your company is so large that it's that critical for Treasury. I always like to compare it, to accounting. When there's just a couple $1,000s that aren't accountable, that's not a big deal. You know that they're there, right? It's just that they're embedded in some sort of line item, and so we're able to maybe put it into a specific account, right? Like that's just the trend. But when it comes to Treasury, if you're not reconciling it to the penny, right? Let's just say that there were some $thousands off. At the end of the day, that could mean that there's somebody taking a little bit of money on a daily basis or on a second-to-second basis. And so that can then end up leading to a significant loss of money if that's due to a bad control, right? So that's what I mean by the impact in terms of financial resources, because everything any organization does is going to likely be driven by financial resources. And so in terms of preservation of capital, back to your core question, what you try to do is just stress test, right? Like I said, there's certain things that aren't controllable, by your organization. So as much as people can get, educated, there's just things that are unexpected. None of us knew that there was going to be a pandemic, right? I don't think anybody expected the massive results of the financial crisis, right? So all of that is really learning lessons from history to figure out how can we think about stress testing our situation so that we know how much to hold. And so again, on the preservation, when I think about kind of getting core to the basics, you always want to over-index on liquidity when the market is good, because that's when cash is available, or in the crypto world, in the digital assets world, right? When financial resources are more available, they're more liquid. You want to over-index for liquidity so that when you are going through and weathering a storm, or some heavy hurricanes and tornadoes, you want to be ready for it. And so what's really key and important is to be able to get the right forecasts and work with key subject matter experts to ensure that those inputs are legit, because your forecasts are only as good as your inputs. And try to get as many opinions around it, right? Get as many historians in to give some indications. It's very hard in the crypto industry because there's not a lot of history. And unfortunately, most assets these days are very correlated to one another within digital assets, which is very different in the traditional markets. And so, if one goes down, most of them go down, or at least that's what we've seen. I think as the industry grows, that might not necessarily be the case going forward. But that's a huge risk, and that's where I feel like is more of an issue to address. And therefore, the two items that are probably key to preservation for digital assets is stability of the cryptocurrency, and then also liquidity of the cryptocurrency. Because even if it is stable, you also want to make sure that there's a market to be able to use it, right? So it might not be changing every day. You've solved the stability item of it, but you also want to make sure that there's a large enough market out there where you can actually, turn it for, what you actually need in the market. Hopefully that helps.
So Roberto, I'd love to bring you in on this conversation of preservation of capital. And one of the issues that people are asking about is how much of the DAO's assets should be left in reserve, how much should be invested, and how much should be distributed to community members. And does the answer depend on the type of DAO? What kind of factors might affect your decision?
Yeah, exactly. I think that you nailed it on that front. Is entirely depending on the DAO. But if we narrow our focus on protocol DAOs, these are DAOs that are governing or managing the plan and the growth of a specific protocol. The priority is to have your runway, like 4 or 5 years, as Shreya said, of some sort of like stable denominated asset, so that you can pay your developers, you can pay your community, you can just meet the liabilities that you have as any other company. So once you have your reserves that basically going to give you that runway, we're talking about generating yield on the remaining assets. So then the question turns into, okay, how that's more of like a portfolio allocation, portfolio optimization question. Like how risky do you want to be with the assets that you're holding? Like you want to go full degenerate and like put everything into like DeFi strategy assets and earn thousands of APY, or you want to be a little bit more conservative and like hold just like a basket of Bitcoin, Ethereum, and some stablecoin. So I think that's where a lot of the portfolio theory that's been developed in equity markets and financial markets can come in handy because it's basically the same tooling. So what's important here is the distinction between having a core part of your treasury, being able to deploy it for your development of the protocol, and then the rest is just a portfolio optimization problem.
Shreyas, I'd love to get you in on this conversation about preservation of capital, but I also want to incorporate a question from the audience about the importance of planning. So should some of these rules be built in up front? And if so, what would they be?
Yeah, it's a good question. I think there's a general question around what should be encoded directly into the protocol, what should be done by on-chain governance, which is token holder governance, but they decide what's happening. And then what should be done by these committees or sub-DAOs, these groups that are elected or appointed by the DAO to as specialists to do different things. And then what should be outsourced to other sort of third-party groups, whether it's companies or DAOs sort of serving the ecosystem. And I think the planning piece is one that I think falls in like maybe a sub-DAO or a committee part of that chart, which is you kind of need, it's hard to do all of this through on-chain governance because you need to have some people kind of accountable to actually know if what is the ROI on the dollar spent over the last year. And that's not something you should just like leave up to like potential token holder governance to to decide if that spending was appropriate. I think you should actually have yeah, it could be an individual or a group or a full-time person just dedicated to just actually vetting these proposals. Because right now what happens is, say for Uniswap or Gitcoin Aave, anyone can come up and put up a proposal to, say, start a grants committee, or to start a group focused on marketing, or to have a developers DAO that's focused on upgrades to the protocol. But there is actually no group that is just vetting kind of, is the spend actually useful? And are we actually, is there some way to relate this to, the growth and the sustainability of the protocol? So I think, yeah, sort of an individual or a group focused on that is important. And yeah, in general, like, one of the reasons why I think DAOs haven't diversified quickly enough, like Llama has been quite focused on this problem, is that it's actually hard from a DAO's perspective, because DeFi wasn't built for DAOs. DeFi was built for retail, and DAOs are different in the sense that they are public. They have to go through on-chain governance. They they're a little more risk conscious, and there's a little activation energy needed to do anything with the treasury, and the size of their trades too, right? So if Uniswap was doing $100 million treasury diversification into stablecoins, that's a very different problem from an individual, swapping, even $10,000 into stablecoins. You just do it on a decentralized exchange. Uniswap has to not just do it of that size, but they also have to announce it before. They have to go through a governance process, which might take a month. If you want to do it entirely on chain and trustlessly, then there's certain mechanisms that need to be optimized to make sure you can have the sufficient level of transparency, as well as have execution that is like a decent execution that isn't just going to tank the token price. And so I think those problems are interesting, where some of these actions, they can seem simple. Hey, just like, get 4 years of OPEX and stablecoin. But the actual implementation requires a lot of tact, accounting for, some of the differences in how you would actually go about the diversification, the mechanism, the interactions with governance and the community.
Can I jump in real quick, Laurie? Because I think Shreya's nailed it on this point. I just want to echo a lot of the things that he was saying. Like, execution-wise, it is very easy to go out there and say, this is your ideal treasury allocation. The execution of that is incredibly hard, because as Shreya has mentioned, DeFi right now is very retail focused. And the evolution of DAO tooling right now is pretty much on the nascency end. There's not a lot of tooling around treasury, for DAOs to like manage your treasury effectively. So it's very easy to say, hey, just put 50% of your treasury in stablecoins and then pay your developers from there. Like, actually executing that trade when you have a $3 billion treasury in your native token, it's not a simple thing. On one hand, you have to handle the community aspect. Like, you have to tell everyone, hey, we're gonna sell X amount of our native token in the open market, and that's gonna cause the price to go down. And then the community might be like, oh, why? Like, this is very bearish for the protocol. Why are you doing this? So on one side, you have to handle the community aspect, and then the other side is the execution of that trade. So we're still very, very early when it comes to DAOs, and even earlier when it comes to DAO tooling. So I think those are two very important components to keep in mind in this space.
Terrific. Let's move on to the topic of diversification, which a number of you have either directly or indirectly raised. Many DAOs hold nearly all of their treasury assets in the protocol's native token. So what are the key issues concerning diversification, both across assets? Flavio, you also mentioned across counterparties. And should the DAOs diversify into stablecoins, into other cryptocurrencies, or into fiat currencies like the US dollar? Flavio, you want to jump in on this one first?
Sure. And sure, and maybe just as a segue to everything else that was talked about, I think also part of the diversification is the ability, to get these financial resources. And even in the traditional market space, right, when you're trying to do a transaction that's really large, you have to always be careful that it's not going to move the markets. And so being able to, break it up into blocks brings up execution risk as well. And so the fact that it's there already in the traditional markets, I can only imagine the difficulty, within the crypto markets. And so, hopefully the community can get creative in figuring out the right tooling for that, because I do think that that should help be able to create more opportunity for doing larger transactions and just kind of moving progress. So I just wanted to mention that to tie it with my peers here. On general diversification, when I think about diversification, just again in the traditional treasury sense, it's a little bit more akin to portfolio theory, right? So you have the concept of cash is king, right? And if I were to translate it for the crypto space, the digital asset space, I would probably say liquidity, for financial resources within that space is king. And so what you always want to do is you always want to be prepared for what you need in terms of expenses and in terms of capital allocation. And so just to define those two, one is just expenses that you need to run, your organization and, pay the folks that are contributing and, keep the lights on. In terms of capital allocation, those are really the investments that you're making on initiatives that require capital. So it's investments that don't necessarily run through the P&L or the income statement, but it's on top of it, anything that needs financing. And so as you're thinking about diversification, in general, kind of diversification 101 is you want to make sure that if markets turn, right, you're diversified enough where at least one of your assets is still really solid while the other one, may be suffering a little bit. So you still have that liquidity. Again, I think, I'd love to hear from Roberto and Shreyas here. I find it just really difficult within the digital asset space because there's such strong correlation in general within the crypto market. So it's hard to diversify. And so then if you were to diversify, you kind of have the options of, okay, at least you have stablecoin, going back to cash is king, right? Something that's a little bit more stable. In the traditional sense, Laurie, you brought up, it's not just about the assets and the securities that are in your investment portfolio that you're kind of looking at as, okay, let's invest if we're not using them so we can earn some yield and optimize. But at the end of the day, what's most important is having them ready to then deploy for the organization, right? Again, to fill your, OpEx and pay your bills, as well as invest into the business for growth, right? So it's what I call growth capital, as well as actually having appropriate reserves for any risk. So those are kind of the three elements. It's keep your lights on, kind of the minimum spend. And, the rule of thumb is at least if you're a large organization, at least kind of 12 months of headway. Maybe for smaller organizations, you should probably do a few years out. Then you have your investments, CapEx, and then any other investments that you want to make, at least have something for the next 12 months and just always have in mind a long-term plan to know what's coming and what's going to be needed for the following years. And then, finally for risk, if you're doing those stress tests, thinking about market risk, thinking about, company risk, making sure that you have the right buckets of reserve capital, that would be kind of the third layer to let you know, okay, here's the size of it. And now it's the diversification of how much of it needs to be very liquid. And so back to the digital asset space, how much should it be in, a stable coin, for example, so that you're not running into an issue where you're going to have a situation of having to change up, the initiatives just because you don't have money enough to pay for them. And so you don't want to create that disruption. And that's why it's so important to plan early and know what your bookends potentially could be, so that when you're budgeting, you're kind of budgeting towards the middle and budgeting more conservatively to know that, okay, we can do this. And whether the markets turn or not, we can get there. And in order to give us that headroom, this is how much maybe we should have in stablecoin to be sure, right? And provide that certainty to the rest of the organization. So that's how I think about, diversification. Again, it's security, it's who is the underlying risk of each of those securities, doing that counterparty risk assessment as well, sizing, and then maturity. Maturity is maybe less, within crypto, but typically in traditional world, you can invest in 1-year notes, you can invest in 3-year notes, you can invest in 5-year notes. And while certain notes tend to be liquid in the markets, the lower tenor, the more liquid they tend to be. So the more easily they're able to get turned back into cash that you can actually then use to invest back into the business.
One of the things that is coming out very clearly today is how we have this intersection between really fundamental, what I'll call old school ideas, with this very new school application. And as Flavia was talking, I have to be the academic nerd for a minute and remind everybody about what Keynes talked about in the general theory in 1936, which is, why do we have cash? And first is the transaction motive, which is cash management. The second is the precautionary motive to deal with unforeseen contingencies. And then the third is that speculative motive to look forward and take a view of the future. And so Flavia, it's, if I may say that, you're very reminiscent of Keynes, which is, and again, I think that's an important message for the audience, because we've got so many things that are so brand new here and so being changed and evolved by the moment. But a lot of these ideas and principles, we have great understanding about diversification and so forth. And so it's important that we borrow from those important historical legacies and lessons that allow us to run businesses well. So with that, Roberto, I'd love to hear more about your thoughts about diversification.
Of course. I think you basically said it very eloquently and brought in case and everything. So I think it's simply, in simple terms, I think the decision here for a protocol DAO, sticking with the emphasis on protocol DAOs, is just having a very good understanding of your breakdown of what is stable coins and what is speculative. So if you want to talk about stable coins and like which stable coin you want, like you put your treasury in, that's another conversation, and there's some risks associated with certain stable coins. But let's just assume like a portion of your treasury is in stable coins and then the remaining is in some speculative form. Finding that balance of how much needs to be in a stable coin is really dependent on how much runway you need to run your protocol. So that can be, if you have a team that is very lean, very small, that might not have to be as big, and then you can have a lot of room for speculation. If your team is bigger, or if you have any other more immediate US denominated liabilities, then that cash portion needs to be a little bit bigger. And then on the speculation side, I think this is where we basically borrow from financial theory. Like we have all these assets, and to Flavia's point, everything's incredibly correlated in this market. So the difference now is that we're starting to see certain sectors within the industry outperforming other ones. So this is where I think having someone that has a very strong understanding of portfolio theory and also a very good understanding of what drives the value or what drives the prices of crypto assets in general can be very helpful. And let's be very clear here. The people that are running a lot of these protocols are developers. This whole industry started from devs. They're not MBAs. They don't have finance degrees. They don't have all this experience. And this is, I think, where a lot of people that are not developers and don't have a lot of technical skills can come in and help this industry push forward, because we've been trained in this area quite a bit. And DAOs, I think, right now are in that portion of need where they need that kind of skill set in order to scale their DAOs properly.
Shreyas, you've written a lot specifically on how DAOs can diversify into stablecoin. So I was hoping you could talk a bit about that.
Yes. So I think broadly you can break it into diversifying via equity and debt. And equity meaning you're selling your native tokens and getting stablecoins, and debt being you're using your native tokens as collateral, or you're borrowing under collateral, but you're basically getting stablecoins to fund some expenses. And so those would be two broad categories. And I think the first way you diversify that is completely non-dilutive is you just earn revenue in stablecoins. And so I think if a protocol's business model is suitable for this, and this applies to lending protocols like Aave and Compound. Aave accrues A tokens in its treasury. A tokens are stable tokens, and so if you can do that, that's perfect, because then you don't have to sell any native tokens. The community isn't upset that you're getting rid of your native tokens, and that's I think the sort of more straightforward way if it aligns with your business model. And then in the broad equity category, one way is to just say, sell your native tokens on a decentralized exchange, or in which case there's it's if it's small, it's simple and easy. You can use Uniswap or SushiSwap or a DEX aggregator like 1inch. But in most cases, for large protocols like Uniswap or Aave, like that, it does make sense to use that because you will get front run, you will get sandwiched, you do MEV, which is minor extractable value. You can potentially use ODC desks or market makers. So you can use Wintermute or Alameda Research or Coinbase, which is an agency desk, and you can have an arrangement with them to basically provide some stablecoins in exchange for your native tokens. But I think the issue with that is it's, some of them may not be as transparent, it won't be as DAO native. You have to sort of trust, there's some trust involved, and you might bring things off chain. But the execution would be way better than it would be with a decentralized exchange. The other mechanisms are, and this is like very interesting, this is what Llama is like building towards and spending a lot of time on, is some of these more DeFi native mechanisms, which is some of these auction mechanisms. For example, there's various types of auctions, public auctions you can use, where you basically let any buyer participate. You can also whitelist the buyers who participate, but in theory, you can kind of open it up for anyone to participate. And the specific auction mechanism is just designed for price discovery to determine the appropriate price to actually swap the Uni tokens for USDC. And so the types of auctions can be batch auctions or a Dutch auction or this thing called streaming auctions. And I think each can be tailored to what the protocol's needs are. And so that's broadly on the equity side. And I would say on the debt side, there's, you can potentially get a secured line of credit against your native tokens. You can borrow, at a variable rate. So you can actually deposit your native tokens in Aave and Compound and get stablecoins. It's not like entirely advisable for like the goals of what you're trying to do with, getting a stable source of capital, but that's definitely possible. You can get a fixed rate loan through like, Element or Yield, or get one-off arrangements with different providers to get a fixed rate loan. And so those would be like, I think, the broad range of options available. I think my bias is towards things that are more continuous rather than discrete, where you don't have to, it's not like this one-off really big exercise, but you can actually do it, every month in a reasonably easy way. And a bias also towards things that are more on-chain and trustless. Just being, people who enter crypto, like you do have, I'm definitely passionate about decentralization and open source. And the more you can design these mechanisms in a way that is forward thinking and, can keep up with where DAOs could go, rather than resorting to, some way you need to actually take these tokens out off chain and have some private arrangement with some group to actually sell them, I think the better. But I think the execution on the entirely on-chain trustless mechanisms aren't ideal now. And so we need to get creative and kind of build towards these mechanisms that can achieve good execution, can be DAO native, can go through on-chain governance, and can be trustless.
Shri asks, we've got a question about an additional form of hedging, which is through financial engineering, buying puts, covered calls, collars, and so forth. Would you or someone else like to speak briefly about that?
Yeah, I think covered calls on your governance tokens are interesting. Ribbon actually has the covered calls strategy. Ribbon.finance has a covered calls strategy where you can sort of put in your governance token and then have some hedging and then earn some yield on it. I think in general, I'm more in favor of, at least in the beginning, really simple actions that don't involve options that you can, you can just execute. Like, diversifying the stablecoins is a simple action that actually is quite complicated to do. And you want to focus on really simple things that, and do it very well. And then I think after that, we can sort of, increase in complexity, because you also need to build, like, if you're trying to execute like a covered call strategy and go through on-chain governance to do that, like, it's just suboptimal. You kind of need sophistication in terms of even the people who get involved in the space, right? You need working groups to emerge. You need DAO investment banks and kind of these, the DAO investment managers they emerge, and you need like a whole ecosystem of sophisticated financial participants to then increase the complexity of what you do with these treasuries. But I think to start off, simple like the key actions I think would be diversifying, liquidity provisioning, maybe sort of selective token swaps, and from there, like more complex ways to maybe earn yield on your governance tokens would be interesting.
If I can follow up specifically with the question about diversifying into stablecoins, by asking the question to anyone, are stablecoins actually safe and stable?
Laurie, that's a rabbit hole in its own. I think yes, to an extent, there's a whole branch of research on stablecoins, and broadly, there's the stables that are collateralized by, or that are collateralized by fiat currencies like USDC. Then you have other ones that are over collateralized by crypto that are more like DAI in the MakerDAO system. And then there's the crazy experiments like Frax and Pay that are like totally algorithmic stablecoins. So this is where my
So Roberto, before you give your conclusion, let me just try to be a bit more agnostic. He's referring to algorithmic stablecoins that are not collateralized, that hold prices steady together through technical means and market incentives. But please go ahead.
Yeah, I think that's still an area that is there's a lot of experiments going on. Some have failed, some have been have some level of success. I think my opinion would be to lean on the experiments that have shown some more success. So outside of the algorithmic stablecoins being something that MakerDAO has gone through 4 years of history now. It's gone through ups and downs, and it's proven to be a quote unquote good experiment, a successful experiment. If you want to be very adventurous, at the expense of also running the risk of losing some of that stability when you go into like an algorithmic stablecoin, then totally up to you. But just know that if you're using that area as your safe haven to pay your devs, then you have an additional risk that I don't think you really need to get exposure to.
Flavia, given your talk about correlations earlier, I'm guessing you want to jump in on this.
Yeah, and I actually want to tie the two last topics together. So when I think about both, I think what comes to mind for me is the simple solution, right? And just simplicity in general. And I'll elaborate a little bit. I think just from all of my experience, having done or dealt with very complex issues, and then also looked at simple to very complex solutions, at least within my experience, history has always proven that the simple is always better. So maybe just tackling the initial comments that Shreyas, you had made, completely agree. Going simple first is always helpful. It's more digestible to people. People understand it. People are able to process it. And so something that is a alternative, or at least a substitute to diversification in general, right, is natural hedging. And so you can do that with the balance sheet, and you can do that with your income statement. And so when it comes to the balance sheet, for example, we've been talking about diversification of our investment portfolio, which is where we're holding all the financial resources to then be able to deploy, right? But if you're then able to naturally hedge your investment portfolio with liabilities, right, that you're going to then owe back, then that's the natural hedge that you can create if you can't necessarily diversify your investment portfolio. So just to give you a very plain, example, if you're dealing with just one native token, and I know I'm talking about markets that aren't as efficient as maybe the traditional markets, but what you would want to do is try to get debt, for that same token. And so if markets change and your investment value drops, your liability also drops. And so you're naturally hedged that way, where you may have less, but you also now owe less. And so similarly on the P&L, if you're making revenue with a specific native token or specific currency, then you want to make sure that you're also paying your expenses in that native token. And so again, that's a very simple solution. You can then add a bunch of complexity and create synthetic derivatives to hedge a lot of that risk. But that's the simplest nature. And that's where I would say, is something that, this community should focus on, because at least it could be done and it's understandable and everybody can probably get it, very easily. And so then back to stable coins, what I think is so important is the transparency factor. And so again, for me, it's the answer to your question, Laurie, is simplicity. If I can actually see a report that shows what the process is, what the due diligence is, what the numbers are, and who's actually reviewing it. Is it a third party, coming in and doing some sort of audit on the reserves? Are there consistent, reporting? All of that to me legitimizes what you're end up hearing. So do your research, right? Do your due diligence. The more transparency a protocol or an organization is providing, the more comfortable you should feel. The less they're providing, the less comfortable you should feel. So for me, it's all about reporting, but then also ensuring that, it doesn't stop there, because anybody can also just make up a report, right? How is that process at the end of the day being backed to get, the community comfortable, that it's not something that's just being done by the same folks who are going to benefit from the good numbers.
So that leads us very naturally to some of the Treasury's other duties and responsibilities. So let me open up to everyone. Any thoughts they'd like to share about key issues concerning forecasting, modeling, reporting the financials, and regulatory compliance? Again, each of which could be its own session, but given the time, let's see what we have to say.
Yeah, I think reporting is very interesting because it's, for the first time, you actually have these large entities that have all their transactions on chain, and so you can it's not easy, and so it does require a lot of work to actually categorize and track these things, and there are tools like Analytics where you can do this, but it is possible to, if you imagine this ecosystem where actually DAOs primarily or only interact with other DAOs or other on-chain entities, whether it's other addresses, then you can have real-time transparency and reporting that's really useful to token holders and to community members in a way that it wasn't possible even in public companies, right? In fact, Analytics' tagline for a lot of time was the next revolution is going to be quarterly or something like that. Just the idea that you don't have to provide quarterly financial statements. You can actually see it maybe real time. You can see it every time you're going up for a vote, and so that's a space that's very interesting and very tied into each of these actions. If you do if you do a treasury diversification by a streaming auction mechanism, the DAO should be able to see real time whether the auction is pending or live. If it's live, how much time is left, who can participate, can anyone participate? In which case they can. Maybe there's a way to whitelist a KYC a participant, and then after the auction's completed, what are the results? Is there a way to compare like the cost of capital with doing it this way versus another way? And these things actually can be fairly transparent. And on the regulatory side, I think it's important that legal is part of the product creation process in terms of this DeFi for DAO space as well. Like if you're designing a way to diversify effectively or to take any of these actions, there's not as much clarity now on what DAOs are. Uniswap and Aave and Compound DAOs, they aren't registered. They're like entities that exist in the ether that have treasuries that are these magic money that we create. And so it's unclear what these are in terms of regulations, but I think we should be quite forward thinking on interacting with regulators as well as doing the best we can to do things in a way that is right, that kind of minimizes liabilities for different people, as well as does it in a way that can set precedent for the long tail of DAOs to do diversification, so to do capital raises, and doesn't interfere with any of the major regulations.
Let's end with a speed round. So the question is a tip for creators or curators of DAO Treasury management. Flavia?
Maybe sticking, I'll give 2 tips. Sticking to the same theme. On forecasting, I would say don't let complexity stifle you from making and taking action. We're all going to be wrong. Even in traditional markets, nobody's right on forecasting. I tell my team, don't give me any number that's too precise, because that just shows ego. At the end of the day, nobody's that correct, right? So ranges are always good. Get your scenarios built in. Direction is more important than perfection. Progress is more important than perfection. And so it's something that I seek constantly. And what I would say is having a plan today is great. It could change tomorrow or next week if circumstances change, but at least always be ready with that plan. Even if it's not perfect, it's always good on the forecasting. And then the other tip that I would say that I think is just really critical to keep in mind is always keep in mind the objectives and the mission of the organization. All of us have certain expertise, and so we tend to have a natural agenda of how we think, whether it's very focused on risk, whether it's very focused on customer experience. But as long as you're continuing to remind yourself what that high level goal of the organization, you're always going to make the right decision for the organization that's going to benefit your ultimate beneficiaries. And so that's critical. So again, being a risk manager, right? It's not that risk is bad, risk is good, right? As long as there's an appropriate return on the other end. And so everything is kind of relative, but being very honest with yourself about reminding yourself, your team, everyone involved, and what the mission is just going to create clarity and allow you to move forward more quickly. Roberto.
I think top of mind from DAO operators would be just invest in community education in the treasury aspect component. I think we have not done a lot of work in that area from a lot of DAOs, and I feel like a lot of these big decisions of how to diversify the portfolio and how to do these things that are money related, based and rooted in portfolio management. If you spend time educating your community on a lot of these research and tools, it'll make your decisions a lot easier, considering the fact that your community plays a big role in how that treasury is managed.
Shreyas?
Yeah, I think creator and curated DAOs are very interesting because, unlike protocol DAOs, these have more cultural components. And so, if you think that crypto enables the financialization of almost everything, that everything includes sort of art and memes and stories and essays. And so when culture is the center of investing, and some of these curated DAOs have large treasuries, these treasuries will hold NFTs, they'll hold social tokens, they hold other assets that are a little more cultural. And so, I think what they could do with their treasury, besides some of the underlying principles that should apply to them in terms of longevity and growth, they can kind of distribute tokens to tastemakers. Like you can distribute, say, your native token to holders of CryptoPunks or other NFTs that you value. You can also recruit, I think, new members to your community in interesting ways and use your treasury to, recruit someone with an NFT or with buying that NFT. You can kind of use, one thing I've noticed with some of the more curated discards is they use their native tokens actively to tip within their communities. And so they think of themselves as building this internal economy. And so they think actively about the velocity of money, almost the volume of transactions that happens in their native token within their community economy. And so I think that's one thing that everyone can kind of learn from, but these curated DAOs especially, pick up on sooner than others.
Terrific. I hope that this discussion has made clear that many of the principles underlying DAO treasury management are not new. Nevertheless, there's unique implementation challenges that arise due to the specific attributes of the DAOs. I'd like to thank the outstanding panelists for their thoughtful observations, and I'd like to thank everyone for attending.
Thank you.
Thank you,
Laurie.
Thanks, Laurie, Flavia, Shreyas, and Roberto for sharing some best practices on DAO treasury management. We're going to take a quick break. We'll resume at 11 a.m. Pacific time with our final session, DAO hacks and ways to avoid them, which is something I think we could all learn a little more about. So see you in a few.